Coming up in this show, I'm going to bring you my comments on the markets. Arby has a sample for you out of stock sectors. He's going to look at the energy sector. Katie's going to show you trade planning with options. That's option trade setup in XRT. I'll bring you a hot minute analysis on the airlines, and then we're going to look at the S&P 500, and we'll look at the short term also, the reversal patterns, and question, is this the start of a correction? Great stuff coming up.
Well, I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone gliding, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week and look forward at what might happen in coming weeks. And hopefully lots of great ideas and opportunities for you throughout the show. Well, stock market investors kept the upside surge going early during the week and then at the end, as cyclical and old economy stocks got a lift, and that moved the Dow up 13 straight days. That's the longest since 1987, but that ended on Thursday. And also, good earnings from some of the techs helped the market move also to the upside, especially when you look at Google and Meta, and that kept the NASDAQ moving to the upside. Also helping was a weird interpretation from analysts that the Fed was actually dovish in their meeting. That euphoria ended abruptly or temporarily on Thursday when the S&Ps were up over 30 and then fell to minus 30 on the report that the Bank of Japan was tweaking its bank rate, allowing its 10-year to go up over the 50 basis points level. That's where it's held for decades. Its yield curve control policy has been around for about 30 years. That is important, as Japan has essentially financed the other markets with the carry trade. You can borrow at zero in Japan. Remember, their bank rate was minus 0.1%, and it remains there. And it's essentially huge that investors are doing that and essentially short the yen. Now, with their inflation rate moving up considerably, up over 3.3%, and the yen they found cheap, in fact, too cheap. Of course, as the yen is cheap and their goods remain cheap because of the yen, then that does feed inflation. So the Bank of Japan finally realizing that their insane policy has to change. If an unwind actually does happen of the carry trade, then the vast number of investors and hedge fund managers that are in that trade may have to unwind their holdings because they are essentially short the yen. So if that's the case, then what would happen is that, well, things that are held based on that money they borrowed, like U.S. stocks and bonds, well, they would fall sharply. That is what we saw, a little scare of that on Thursday as the market reversed. Early Thursday, it looked like the markets were going to make it 4 for 4 straight, and investors celebrated Powell's message because what they heard in the press conference was that he could hold rates steady. And then the market jumped on that news, but they ignored so many other things that he said. He said core inflation was high, labor market was tight, policy is not restrictive enough for a long enough time to get the desired effect. And the data could say that they needed to do more. But investors just prefer to hear what's bullish, and they bid stocks up. That is, until the news came on Thursday, when the stock market moved down, both on what was a stronger GDP than expected, and that Fed and that Bank of Japan action, which actually did come on Friday. And we think that what we saw with that big up and down movement says that actually the market is susceptible now to down moves where it appeared it was not before, especially with the Dow and those cyclical stocks moving up day after day. Friday, we saw the market moving up again. The Bank of Japan, they held the rates negative. And they said that they were going to allow it to drift over the 0.5% on the 10-year, but also saying that they might let it get up as high as 1%. So that's certainly needs to be watched. We put out a bearish trade idea on the yen early last week, and that has proved to be fruitful. The PCE, which is what is heavily watched by the Fed, came out in line, basically. But the S&Ps like that when they saw that, and they were already strong, figuring that, well, yesterday was just an aberration. And what we see is the S&Ps up 44 points here as we do this recording at midday, a very big recovery from the reversal. But I'm going to show you those charts and the reversals that I think are significant, calling levels that may be a challenge now for the stock market. And for the stock market, despite some very volatile action that we're seeing in these last couple days, it's still strong. Our momentum indicators have reflected that, and that has lifted the market as momentum keeps driving to the upside. And our timing for the rally has been for it to find its peak sometime around mid-August. Granted, it's above the levels we expected, but all of the indicators have been reflecting that possibility. Still, I can't close my eyes to valuations that are very high to crazy high. Recent article that I saw in Zero Hedge illustrated this very well. And what they did was compared several different measures of valuations and then showed one that I think is pretty extreme. It compared the Buffett indicator and said that and others like the PE and the Shiller PE were all overbought. And we know that the valuations are very high as far as that goes. But the chart that they shared that shows the yield curve, I think is really historic when you look at that. So let's take a look at this chart that they shared. And this is the yield curve model, which is extreme overvaluation and very big risk. Let's just take a look what this looks at. And they compared the Shiller PE, the Buffett indicator, all being overvalued, but this one being really extreme. This is more than it goes back more than 50 years, back to about 1960. And when it gets over this point of inversion, in other words, the yield curve inverted, it sets up recessionary conditions. And each one of those recessions came with big declines in the market. Of course, there was this period right over here where it was very high, the inversion, and then the market moved down sharply in 1970, and we had this gray area, which is the recession. Same thing happened over here in the mid-70s, and we're comparing the mid-70s to now in a lot of our analysis. As you saw, the market move down. This is the next recession there. These are the recessions here in late 70s, early 80s, and you could see it really got to extreme inversions right in there. And of course, the recession here it got to a period of extreme overbought or extreme inversion in the yield curve. And of course, the recession came right in this period here, and then the market declined. Didn't decline a huge amount in here in 1990, but here where it inverted a lot, you can see we had that big bust of the dot-coms, and of course the market fell very sharply right in there. This is where it inverted in a very big way here in 2006-07, and then the big financial crisis and the big recession right in there. This little gray area right there, I don't even know if you can count, though it did get inverted right over there, because that is the decline that we saw from the pandemic. And look where we are now, historic levels of inversion right now. And based on what we see in here, I mean, over these last 60 years, it's 100%. 100% of the time when it gets over this red line, what happens is that the inversion is so big, the tightness from the Fed is so large that what happens is the market goes, the economy goes into a recession, and sometimes takes some months to get there, and then the stock market has a very, very big decline. I think this is really important to look at. You might say that, this time is different. And I would tell you that this time is different in the way that the amount of extreme stimulus that the Fed put in previous to this is really holding the market, the economy together and the market together for an extended period of time. And that sometime out there, that is all going to get corrected, and we'll have a recession, we'll have an earnings recession, and we'll have a stock market that reflects that with some sizable declines. So I think it was really important to look at that chart. The analysts out there, they're giving up on the recession or calling for soft landing, but this shows 100% of the time you get these big economic pullbacks and you get the stock market that moves to the downside. So for me, this is a challenge presenting this to you because, as I said earlier, all of our indicators are bullish. The market is going up, momentum is strong, investors are happy, sentiment is getting better, and traders really have to look at this and say, well, I can't really be short because the indicators tell me not to, so you really should listen to what they're saying. But investors, it's a different story. I say don't worry about missing a few points to the upside, a few percentage points to the upside, because the risks are just plainly too big. And I think that showed it to you very clearly. I want you to go to askSlim.com, explore our website, get acquainted by becoming a level 1 member. It's only $45 for 3 months, and you're going to get great information from us every single day. On YouTube, subscribe to our channel, click that notification bell, and you will know when we put videos up. Do like this video, give it a thumbs up, and on Twitter, follow me at askSlim. Actually, I should change that to say, on X, follow me at askSlim. For any questions that you have about our memberships, information on our education and analysis, write to Matt at askSlim.com. This is Stock Sectors. Avi does a fantastic job teaching our style of analysis. You will love this. He looks at XLE, and he's going to show you the indications that are positive.
So this is our weekly cycle analysis for the SPDR Energy ETF or the XLE. Now we have 2 cycles at the bottom. We have a red cycle, which is the crude oil weekly, and we have an out of phase blue cycle, which is the XLE weekly. And what we're seeing here is that we are in a rising phase on both the XLE cycle as well as the crude oil cycle. That's this rally here. This is in the overall context of a bearish cycle structure with a lower cycle low versus that O low. We are, however, looking for still higher, likely back to that 78.6 fib around the 89.30 area in the XLE, and then we'll be watching to see if this can actually put on a higher low basing cycle into this low, which is due 10.2 to 11.13, and then turn up again. All right, so that's what we are watching for here in the XLE. The overall bias on the intermediate term is positive still as we are looking at it.
Great work on that, RB. This is Katie, and she's going to bring you trade planning with options. Katie is going to share bullish options trade in XRT. And she combines our cycle analysis with option strategies, does a fantastic job at that, and you're going to really get a good sense at how to put it all together with the information we provide here at askSlim.
Hi, this is Katie Anagnostos, and this is a trade planning with options video on July 27th, 2023. Today we're going to look at a short premium trade idea in one of the askSlim focus list ETFs. First, we have our legal disclaimer, the options trades that I demo and follow up on our trade ideas. When I talk about closing, adjusting, or managing them, I'm simply educating around management techniques, best practices, theories around risk management and profit taking, and highlighting aspects of options trading that we encounter as we follow these trade ideas. This disclaimer is specifically related to options trading. For full legal information, please go to the askSlim website or email matt@askslim.com. Let's get started. We're going to start today by going to the Tasty Trade platform. I've created several watch lists in Tasty Trade, and one of those contains the ETFs that we have on the askSlim focus list. You can customize these columns. I have IV rank as one of mine, and I've sorted the list from highest IV rank to lowest. And XRT comes up on top. That is the retail sector ETF. And that's the one I'm going to look at today. I'll take you to the chart in a moment to look at the analysis, but first I'm going to show you where you can access a link on the askSlim website to learn more about Tasty Trade, our preferred options trading platform. If you hover over this Marketing Partners tab and click on the Tasty Trade link, that will take you to a page that contains a link through which you can open a Tasty Trade account. Doing that through our link will benefit you with some special bonuses, and it will also benefit us. Now let's take a look at the chart. This is the weekly chart of XRT. We have relatively short 16-bar cycles in here. The weekly cycle timing window starts in 2 weeks on August 7th and runs through September 15th. That's the period of time marked by these vertical blue dashed lines when we would ideally expect XRT to make an intermediate low. As of right now, this cycle appears to be configuring positively with a right-hand translation. That means that the cycle is peaking near the end of the cycle, leaving little time for a retracement, and that the cycle appears right now as if it will end higher than where it began. That would make this a basing cycle. Now, momentum on the weekly chart is positive. You can see that with our proprietary momentum indicator, the reversal scout, with a positive slope and green in color. Now XRT has gotten into that upper resistance zone near the 61.8% fib retracement, showing some upper wicks there. Still, we do have positive momentum. The next resistance level beyond that is the 78.6% fib retracement at about 71.5. Now we have this rising support zone currently running from 63.36 on the top to 60.62 on the bottom, with a 78.6% fib retracement at 58.68. Now we're going to demonstrate an options trade using the September 15th expiration cycle that matches with the end of this weekly cycle timing window. Switching back over to the Tasty Trade platform, let's open up that September 15th expiration cycle with 50 days to go. As I mentioned at the beginning of the segment, XRT has the highest IV rank amongst the askSlim focus list ETFs. We're going to set up a short premium trade idea. Now we need to give a heavy weighting to the positive momentum conditions, so I'm going to use that next highest retracement level on the upside to give us some room. I'm going to sell the 72 call, which is just above our 78.6% fib. I also want to cover the support zone since we are approaching that timing window. The bottom of that was right around 61, so let's sell the 61 put. Now this gives us a 1 standard deviation strangle. You can tell where that is on this platform by this very light blue dotted horizontal line. It also covers the expected move, which is marked by this vertical brown bar. Now, of course, you can move your strikes around to suit your risk tolerance. You could also buy wings to define your risk and create an iron condor if you prefer a defined risk strategy. However, in that case, you will likely have to move your strikes in to collect sufficient credit. So for this strangle, we collect $1.13 in credit. That is our max profit. Max loss is down to 0 on the downside and theoretically infinite to the upside. Now we need about $780 in capital to place this trade. Our probability of profit is 74%. We do pick up a couple of short deltas and a daily theta of almost $3. Let's take a quick look up at the risk graph. We'll zoom in a little bit. Here it is. We have our profit zone in green, loss zone in red. We want XRT to stay in between our short strikes, or at least in between our break-even points. So if this goes against us, we can roll in the untested side to collect additional credit, and we can also roll out in time since there are no earnings to worry about. As for a profit target, we're looking to take 50% of max profit, so about $60 per strangle. That's our trade planning with options video for today. As always, please feel free to reach out on Discord or via email to Katie at askSlim if you have any questions or feedback.
Love it, Katie. Great work. And remember, go to our website, go to our partners tab, and open an account at Tasty Trade. It helps us, and it's going to help you with the specials that they offer. This is our level 4 special trial, top tier. This is for first-time subscribers and upgrades. You're going to get this unbelievable amount of content and analysis and education for 35% off. That's only $101.25 per month versus our regular $159 per month. And you're also going to get our new market condition monitor, the MCM, which is included in level 4, and that is the premium version, and you're just going to love that. I've showed it a number of times. This is just a little picture of that right there, and everything that you're going to get in level 4 is included in this list, including everything in levels 3, 2, and 1, 35% off. You just can't miss this deal. Click the Learn More button at the top of the askSlim.com page. It's going to give you a lot more details, and you will have the opportunity to sign up right there. This is a hot minute. I'm going to bring you my analysis on the airlines and jets, which is the ETF on that sector. I think you're going to love it. This is a hot minute. We're going to look at jets, which is the ETF on the airline stocks and the broader manufacturers also in airlines. It's a very good ETF to look at and compares well to the airline stocks. We'll look at United Airlines, American, and Delta also. We've had some big declines. Southwest moving down about 9%. On some bad earnings, and also we've seen Alaska Air have a big decline also, and investors are starting to look forward as costs are rising. The cost of energy, of oil, has been moving up, and there is of course talk of a recession coming, and all of that weighs on these stocks. They have been moving down, and I think it's important to look at them because this is kind of a short to intermediate term look. There is some risk here for the next month or so that I think is important to mention. Let's look at jets first. This is a great chart because not only does it show you our cycle analysis, but it also shows you those periods of risk. That's what the yellow areas are, and that's where you have a nesting of the cycles that you can see on the bottom here. These are the cycle brackets where each of these minor and dominant cycles make up the harmonic families, as you could see, and you could see how these lows align here and here and here beautifully. These were negative cycles as it was moving to the downside, positive cycle and a positive cycle. But this is that next period of risk that's coming in, and this aligns with the other airline stocks, and there could be some sizable downside moves here for the next 3 to 6 weeks in the airline stock. So this is a risky period, and it's important to mention that. Let's just look at the other airlines that we talked about. We'll take a look first at United Airlines. Take a look here as we look at similar information. You can see that I have that jet cycle overlaid. That's that green dash, and it almost completely mirrors what we see here for United Airlines. That makes this period of risk right in here very important. You could see as it reverses to the downside here this week, we could see United Airlines easily get down about 5 points from here in this next 3 to 6 weeks. So there is some serious risk when we look out here into September and maybe even to the early part of October for United Airlines. Let's look quickly at the daily chart. And this has been resisting this area a lot. You can see an evening star here, an engulfing pattern, an evening star, and then turning down. So this shows you that there's risk here, probably a failing rally, and then coming down again. I do not like United Airlines when we look at that on the weekly and daily chart for this next 3 to 6 week period. We'll take a look here at American Airlines. We'll go back to the weekly right here, and you can see the same thing in here. Now this is pointing down to getting down here between under 16 and close to about $15 here in American Airlines. This period of risk is certainly alignment with what you see in the jets, which is that dashed line right over there. So this comes out into sometime into potentially October, and we can see there is some risk here in this short to intermediate time frame right there. And let's just look at American Airlines on the daily chart, and you can see that that has turned down. You can see the engulfing pattern and the momentum here. You can see the slim ribbon PO on the bottom as it gave you all of those bullish signals right over there. It's been a bullish stock, and now it has turned neutral. We expect that it will turn bearish fairly soon. The last one we're going to look at is Delta, DAL. As we look at these three big stocks, let's switch back over to the weekly right here, and you can see the same thing. We're pointing at Delta for a potential move down into mid-September to potentially October, getting down to about $40. So that's a $5 or $6 drop on the downside. Pretty significant when we look at that. It may be some good opportunities for buying in that drop, but right now we're concerned with just this period out here from out in mid-August through potentially October. Look at this diamond top that formed in there and that engulfing pattern, and then it breaks down. The same thing I showed you here on the slim ribbon PO, bullish signals you can see in there, and now has neutralized. So we have a weakening of the momentum conditions here in these stocks. When I switch over, you can see the weekly still, as we have in all three of these airlines, still has upside momentum. So it hasn't quite failed yet, but that daily information is telling us that it is starting to fail. So between the look at jets and these three airlines, it's pretty, to me, insightful looking at all of that, is there's these alignments that say the next 3 to 6 weeks out to potentially early October has some a risky period here for jets and for the airline stocks. All right, stock market analysis and projections on the S&P 500. Please do read this slide. It gives you a good idea of our approach to analysis and what's important to you about applying it to your own trading and investing. All right, stock market, S&P 500. We're going to look at the weekly SPX, and we're going to look at some daily charts, which you can see the reversals that occurred on the indexes. Now, while the stock market is recovering here on Friday very significantly, in fact, it's recovered some 3/4 of what it lost on Thursday from its peak, the decline off of those levels we deem as important, and likely to be telling us that somewhere around these levels is some resistance that we'll see in the market. So let's take a look as we switch over to the SPX, and this is SPX, and I'm looking at 4 harmonic families here in cycle analysis, and you get an idea of what that looks like right in here. You can see the important low there and an important low here, and this is that harmonic family right over there with a minor cycle and a minor cycle. You can see right in here the minor cycles that make up the dominant cycles. There are 2 of them in each. This one right over here, barely perceptible because the market was so incredibly strong and rising again. I also want you to note that momentum has been positive, and it turned positive way back over here in March of this year and has remained positive, as you can see, by our Reversal Scout. Reversal Scout is a level 4 study that you get to put on the Thinkorswim platform. So very important to have a good handle on the momentum conditions. Now, what's really important now, and in the beginning of the show, I commented that valuations were very high and that it's important to understand that there may only be, for investors, a few percentage points available on the upside versus some significant risk. So in cycle analysis, we do our projections in not only in price, but in time. And that's what's so valuable about this style of analysis. If you go back over here and look at this yellow zone, this is the period of risk where both cycles are coming down. And you can see in here our projection was that the period of risk, the period that it was likely to be declining in these declining phases, was between January and March. And it fell right over here and made its low around mid-March. So that was pretty spot on. Here, the period of risk was mid-September through October. So we believed it would decline from somewhere mid-September, and it actually fell from late August through October, and it made its low right over here October 10th, the week of October 10th. You could see the quality of that also. Here, the period of risk was January through April. So it made its peak over here in January. It declined over here through mid-March, and that was pretty spot on. You could see that these periods bring you very sizable declines in there when both of these cycles are in corrective mode. That's what happens. So now where are we? Well, the period of risk in here is suggested to be August through October. I think it's early October. And here we are still moving to the upside, as you can see, with only some minimal sense of a decline of a peak actually starting with some of the volatility that came in Thursday. And I'll show that to you. What we have been projecting was a peak in this market sometime in mid-August. Either it gets up to here to 46.65 or it stalls in this area right now around 4600. Those are the areas of the fib extensions that come from the daily charts and create a zone of resistance right in here. So while the market may still do better through the end of the year, as we have it projected up here into November, December, this period of risk is significant. Now, we don't know if it's going to just come down modestly and get down here to 44.20, if it's going to come down kind of an average amount and get down to 4,300, which would be about 300 points, which would be actually less than this one here, which was under a bullish condition. Or get down over here to 42.08 approximately. So those levels right over there are 42.20, 4,300 and 42.10, let's just say, right there. These supports in here are important levels, and that's what we look at for the correction. You can see in here, it got down to the support level right in there. These were negative cycles, so they did much, much worse, and this is a positive cycle, so we're only anticipating a decline of, let's say, 300, 350 points, which would be pretty normal, and that would be maybe 7%, 6, 7, 8%, something like that during that period, and then moving up again. So the period of risk in here is important to be very conscious of, and add that to the market likely to, at some point in here, begin to discount a recession coming out there, as we showed you the extreme conditions at the beginning of the show. If you scrolled forward or you're only watching a clip of the show and you did not see the chart that I showed in the opening comments, go back and look at it. It shows you the for the last 60 years, the inverted yield curve situation and the extreme we're at right now, and the very, very high likelihood of a recession coming. I think it's important to look at that. So many of you have not watched the beginning of the show. I encourage you to go back and watch that now. Let's take a look now as we switch over to the daily charts. And I'm going to look at the daily chart right in here. So what we have in here is what I'm pointing at right here is this harmonic cycle right in here. These and these cycles here. These point to troughs that come late September, early October. What that says to me is that, well, we started a little pullback in here. Maybe we've seen it all, I'm not sure, but there's a probability that this comes down again and gets back down into the slim ribbon and then begins to move up again. And then we're looking for that peak somewhere out over here in the second to third week of August, right there, and then beginning to move down pretty significantly. This engulfing pattern is important. It gets up right to that fib extension level right over there, and tells us that the market is susceptible right now. But the S&P is now up 50 points here on Friday. well, you would say the buyers are pretty solid and the market momentum is very solid. I showed you the weekly market momentum. Here's the daily, and you could see the slim ribbon PO with these upside resumptions that you can see right over here. And we're getting that upside resumption there. So this level right over here of, 45 and a quarter, may be the worst level we see right over here now. And then it moves up again into this August period. Again, looking for somewhere between 4,600 to 4,665 as the likely peaking area on the weekly chart. And this area of risk, you could see, is only minimal. When you're in a bullish condition, that only moves down for a few days, as you could see, 4 or 5 days, as you had here and here and here. And probably here, we'll probably get some pullback early in the week, next week, if not 4 or later here on Friday. And then again, trying to move up again. Again, this peak shows us up here in the period of the second to third week of August. Now, that is in alignment with the VIX. The VIX is showing us a trough coming in the same time frame, and it says to us that implied volatilities will bottom sometime in mid-August, and then probably see much higher implied volatilities. We're looking for 25, 30 potentially in the VIX coming up in that September to early October period. So that's when that big risk is. Let's take a look at the NASDAQ on this daily chart. And you can see that right in here. And got a little extra line right there. And what this is the same thing. So there was a pretty good reversal that we saw right in there. And the reason the reversals are green in here, for those of you that are not familiar with our charting, is that as long as the slim ribbon is positive and the slim ribbon PO is green, then it will color these in white and green, because it tells us that the conditions in momentum is positive. Again, this is a level 4 the slim ribbon PO, and the slim ribbon with this programming is free for the Thinkorswim platform. So you can get that by going to our website and then download it on your TOS platform. So that gives you a great sense of that. Also, the slim ribbon is on Tasty Trade, so you can put that up on the Tasty Trade charts also. So that's a look at the NASDAQ. Again, we're looking for a little bit more pullback in here and then moving up again sometime into that mid-August period and then coming down again. This cycle right over here on the NASDAQ is pointing to sometime around mid-September for that low, and versus a little bit later on the S&P 500. But still, you get the same idea. The risk out there is mid-August to mid-September or early October for the market to have more of a setback. Let's take a look at the Russell RUT. This is interesting. RV encouraged me to put the mid cap on here because it's so reflective of what has happened on the small caps. And you can see these green, the green overlay in here is the S&P mid cap with cycles of 58 and 29 on the minor. So you can see a great reflection of how the cyclical patterns are working, both looking at the small cap Russell and the mid cap S&P 500. And what that points to, looking right over here, is that comes out to late September. So the correction we're looking at in the Russell coming out to mid-September to late September. Also, there's a possible left-hand translation when you look at this. What a left-hand translation is that that the peak of this cycle that we're looking at right over here may have already come on this reversal pattern. If this if this comes up above this level, then we'll know that it's not a left-hand translation, that it's just there's an upper track that belongs in here. And I'll put it back if that's the case. But right now, this is a warning. You see the evening star right over here and the reversal pattern right in here, making a double top. Even though it's come back here, it still doesn't tell me anything other than this area right in here is some resistance showing up. And you can see the cycle peak from the weekly chart right there. That is this area of resistance. It got up into the target zone and is finding resistance. So with 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, roughly 10 days or 2 weeks spent in this with 2 reversal signals, it says to me that the Russell is probably done going up. So I took out the upper track, and put in that note that it's a possible left-hand translation until it proves me otherwise. Also important is pay attention now to this mid cap right over there. You could see the minor mid cap right there and the dominant right there. That would be in alignment with some pullback in here, one more rally out into August, and then moving to the downside again. So that's a look at the charts here. Now, don't go away, because I want to show you our ranking system. Because if we're in an area of peaking, well, the stocks that are bearish probably are going to go down, but the stocks that are overbought, very overbought, probably don't have much upside potential in them. This is our ranking system of our 84 best traded, widely held and ETFs in here. What I want to do is click on the OBI right there. And then when I look at the OBI, I'm going to look for stocks that are, first of all, bearish, as you can see right over here. AMD, Disney, XBI, of course, the dollar, the US dollar Canadian, which we've been bearish on, and the US dollar JPY, which we've been bearish on. We're looking at the OBI specifically. But what I want to do is scroll down here to where they are orange. And what the OBI orange is a short-term extreme overbought condition. And these are stocks that have been moving up. And you can see in here, looking at our overall very positive conditions in the Boeing and the FCX. The market outlook, it shows you what they are, potential downside short-term corrections in positive intermediate conditions. Why does it say that? It says that because this is all positive, but the OBI is giving you an extreme warning. What are those extreme warnings we see in Boeing, FCX, Goldman Sachs, Home Depot, JP Morgan, Morgan Stanley, as you can see right there. And oil is on there, gasoline is on there as they've been moving up, and heating oil right there, likely to get some minor pullbacks. The ones that are all straight green across are the ones that are likely going to be buying opportunities when they pull back, and the other ones maybe not so much. But most of these are pretty bullish, except for the long term, and giving you some sense that when they are orange, the market outlook for the next 3 to 6 weeks is telling you potential short-term downside corrections in overall positive intermediate conditions. This is fantastic. This, by the way, is available to level 3 and level 4 members, and I think it's just packed with important information. Again, you can scroll on there. You want to look at what the long-term positive or negative are. You can see that right there. Intermediate term positive or negative, as you can see right there, or the short-term positive or negative there. And, of course, the OBI. So you can scroll on all of those. And, of course, our charts are on there in static version for our level 3 members. So level 3 and 4 members get this, and I don't really know how you can operate without it. I think it is fantastic. That's a look at the stock market, and just overall looking for some peaking in here and a pullback into September or potentially early October, and then probably a move up into the fourth quarter. That is it. I hope you loved what I presented to you. Please don't forget you can get our level 4 special right now for 35% off. Everything you see included on here. Please do click Learn More on the top of the askSlim.com front page, and you'll get all the information that you need there. And if you have any questions, write to Matt at askSlim.com. Please go to our website. If you're just brand new, sign up for level 1 for $45 for 3 months. You'll get tons of our great information. Subscribe to this channel. Give us a thumbs up. And do watch our member videos in the playlists and past shows. On Twitter, or let's say on X, follow us at askSlim. And any questions you have, write to Matt at askSlim.com. That's it. I hope you loved our information. I want you to be so careful out there. It is so crazy out there. And I'm always wishing you great trading.